Hello investors and future investors, welcome to the channel. Happy Columbus Day if you're into that kind of holiday. I'm super excited the stock market is open today. So in today's video, I will show you an option strategy that can be used now that the market is trying to go back up. And I'll show you a few stocks that's best for this strategy. So if you're new to the channel, thanks for stopping by. On this channel, we help you with option strategies that can give you consistent revenue and everything related to finance and investments. And yes, you too can make money from your living room with options trading, and I'll show you how. And all I ask in return for this free content is an early thumbs up by you hitting the like button. And while you're down there, consider subscribing for more ways to win with options. Welcome to Investment Gains. Let's jump right into it. So for today's option strategy, I will show you the strategy that I used when my account was below $300. Now, that strategy is going to be the call credit spread. Now, this strategy is perfect for small account holders. And although you have to trade about 2 or 3 times a week, it is and it will be beneficial and help you grow your small account. So let's go into trade SPY options. First, to open up the SPY option chain as usual. Now, we're going to go to sell and call, and we're going to choose our strike date of October 13th, which is just 2 days out. Now, we're going to do our call credit spread above our share price. Now, we're going to go with the $42 strike price, and that's going to give us a chance of profitability of higher than 75%. So we're going to click into that. And since we're selling a call, we're going to receive 0.94 or $94. As you well know, each option contract is multiplied by 100 shares. Now, that is leg 1 of this 2-leg option strategy. So let's jump into leg 2. So leg 2 involves buying a call. So make sure it says buy and call. And now we're going to choose our strike price above our current sell call. So for that, we're going to get the 443 and we're going to click into it. Now we're selling a call. So since we sell a call, now we have to pay. So what we're actually going to be paying is going to be 0.61 or $61. Now, if you look to the top here, it says call credit spread. Now, I know I explained this very simply, but that's what it is. It really is a very simple strategy. So if you get anything else that does not say call credit spread, you did it wrong. And I suggest that you replay this video in order to get it correct. Now, with the call credit spread, once you do it, you will be receiving a minimum credit. That minimum credit is going to be $31. Now, that $31 is yours to keep no matter how this trade goes. Now, in order for you to do the strategy, you will be asked to leave a collateral. So let's go into continue. We're going to choose the amount of contract, which is 1. Let's hit review one more time. And there you have it. So in order for you to do the strategy, you will be asked to leave a collateral of $100. So actually what you're doing is that you're leaving $100 to get $30, which means you're risking $70 to make $30. Now, the beautiful thing about this strategy is if done on the Spider ETF, it can be done 3 times per week, since the Spider ETF have 3 expiration dates every single week. So $30 every other day really adds up. It will give you around $90 per week. If that's not good, then I'm not sure what good is, especially for someone trading for a very small account. So let's get into how do you win this and how do you lose this strategy. Well, first of all, win. In order for you to win this strategy on expiration date of October 13th, you ideally want the SPY to be trading below your sell call of $42. If that happens, then you get to keep your minimum credit and you get your collateral released back to you in order for you to do the strategy again another time. Now, the other way this strategy could go now, if once again on October 13th, if SPY is trading at $43 or above, then once again, you keep your minimum credit, but this time you lose your $100 collateral. Now, there's also a third way in which this could result. If on expiration date, SPY is trading anywhere between 443 and 44, then you get to keep your minimum credit and you get part of your collateral returned back to you. Now, the reason why I like this strategy is because of the cost of entry. If you're trading with a small account, let's say $500 or below, then you're only risking about 20% of your portfolio on each trade, which is very good odds. Now, the cost of entry really does make this very attractive for small accounts. Now, if you are trading with a bigger account and you want to level up, so to speak, then what you can do is increase the amount of contracts. So instead of going with one, you could go 1, 2, 3, or 5. However, I never advise going into many contracts. I would more advise diversifying. So instead of doing 3 contracts on SPY, I would do 1 contract on SPY, another contract on a different stock, and another contract on a different stock, just to have variety in my portfolio. Now, I did promise you I'm going to show you some other stocks which can be used for this strategy. So let's get into it. The second stock or ETF that I would use to do this strategy would probably be QQQ. Okay, so here we are on QQQ. Now, QQQ is another ETF. So let's just do one more demonstration on the QQQ ETF. If I were to do a call credit spread, let's go once again into the trade QQQ options. So once you do a call credit spread, it usually defaults to buy and call. Now, I like to go over to sell and call to start off my call credit spread. Now, the reason for that is that when you go to sell and call, you do get to see your chance of profitability. The chance of profitability is what I use to gauge what strike price I will be buying. Now let's go back to buy and call, and you're going to see the chance of profitability has disappeared. Hence, I always start off my call credit spread with sell call. Okay, so let's go sell and call, and let's not forget to change our strike date. Let's go October 13th. Now let's go ahead and we're going to choose our strike price once again above our share price, and we're going to go with the 366. With the 366, that gives us a 80% chance of profitability. Let's hit into that. And since we're selling it, we're going to receive 0.7 or $70. Now we're going to go right away to buy and call, and we're going to choose the strike price right above, which is going to be 367. We're going to click into it, and now since we're buying, we're going to pay 0.46. The difference between the spread is what's going to give us the credit of 0.24. Let's hit continue. We're going to choose the amount of contract, which is 1. Let's hit review order, and there you have it. So you will be receiving a minimum credit of $23, and your collateral will be $100 once again. The reason I would use QQQ as well is that QQQ also has multiple trading days per week, which enables you to do this trade and get probably above $20 every other day. Now the other stock or ETF I would use would be the Russell 2000, ticker IWN. Let's just go into it. I'm actually not going to do this trade. I'm just going to show you. So here it is, the Russell 2000 IWN shares. Now, the call credit spread is a very good strategy if you're trading with a small account. It allows you to receive a credit right away once you do the strategy. And also, when getting into the strategy, you only have to use a small percentage of your portfolio in order to enter, which makes the cost of entry into a credit spread very favorable for small account holders. Now, we have lots of strategies like this on this channel. So if you want to join the weekly income team, like and subscribe right now. Also, hit the notification bell to get an alert when I post a video. But most importantly, if there's someone out there you think that can benefit from this video, feel free to share it with them. Let's help as many as we can. Thanks for watching, and remember, always keep pushing your investments.